Chapter 10 of Management, an Integrated Approach, Performance Management, Part 2. Chapter 10 Discussion. Chapter 10 Discussion questions to think about while reading this chapter. Discussion Question 1, on the value of measuring. What does it mean when a manager says, if you can't measure it, you can't manage it, why can't you manage it? Discussion Question 2, on the value of benchmarking against other companies. Why would a company benchmark its performance against companies in different industries? What value can be derived from considering these completely different business contexts? Discussion Question 3, on the value of maintaining transparency with employees. What tools can companies use to make their performance against key metrics transparent to all employees? What are the advantages of being transparent? Setting performance targets. After using the balanced scorecard or another system to identify key measurements, the next step is to set performance targets for those measures. Setting goals and measuring their achievement is a strong motivational force in itself, which becomes more powerful when targets are meaningful and serve a greater purpose. One way that companies set performance targets is by comparing or benchmarking their performance to other companies that are considered best in class in their respective industries. Benchmarking. The concept of benchmarking broadens a manager's perspective to look outside the company, primarily at competitors, to assist with target setting. Benchmarking is the process of collecting data from the industry's best players and using their measures as a goal or guideline. While the goal is to learn how an organization compares to others on specified measures, it has industry-wide benefits. Benchmarking promotes competition and reveals best practices so that they can be analyzed, adopted, and implemented throughout an industry. Benchmarking also has benefits within an organization. It stimulates an unbiased review of internal operations, reveals problems for which others have found solutions, and provides objective data and targets for improvement. When implemented appropriately, benchmarking includes the following: identifying the processes to benchmark, choosing measurement criteria and collecting data, finding the best companies for each process, analyzing data, creating plans for improvement if a company adopts a rigorous benchmarking program. Members of an organization apply all of their energy and ingenuity to improve their performance, in hopes of matching or exceeding their competitors. The most difficult hurdle to overcome is finding other companies to share their processes and data. Few companies regularly collect and share data, making it costly to find useful benchmarking partners. Still, any effort to look outside the company for best practices is useful. While it may be difficult to implement a full benchmarking program, elements can be used effectively with other systems described in this chapter. One novel technique that some managers are using to benchmark their operations is job swaps. In a job swap, one executive switches jobs with another executive at a different company for a day or a few days. For instance, Dharmesh Shah, the Chief Technology Officer (CTO) of HubSpot.com, an internet marketing firm, traded jobs with Paul English, the CTO of Kayak.com, an online travel pricing company. Shah hoped to understand how to recruit top engineers to his firm and how to improve customer service. He walked away from the experience with several insights for improving his startup. Of course, job swaps must be carefully selected. They tend to be useful when there is a lot of trust between the two executives and the companies are in different, non-competing industries. Budgets. For most of the 20th century, the budgeting process was the central control mechanism for organizations because of its ability to integrate all aspects of an organization's activity into a single, coherent summary. It still continues to be used in many organizations today. Budgets are generally created at both the corporate and department or business unit level. A budget typically includes revenue and cost projections for each unit, and these projections are used to allocate resources, for example, human resources, capital equipment, and R&D funding, throughout the company. Once approved, budgets are used to measure the performance of a particular unit or department. These measurements generally occur monthly and include a comparison of actual revenue achieved and costs incurred against budgeted expectations. Units that do not perform as expected often must outline the reasons for their underperformance and define a corrective plan of action. The budgeting process also plays an important role in providing an annual financial yardstick with which to measure progress. Although recent research suggests that some aspects of budgeting can hamper organizational potential, it still remains the primary management system for setting short-term targets, allocating resources, and reviewing performance. Because budgeting is so central to many organizations, and has been used by them for a very long time. Managers who want to use contemporary measurement systems such as the balanced scorecard must link the new systems with the old ones. By combining the budget with the balanced scorecard, organizations translate their strategy into scorecard measures and set targets for each measure. Monitoring and measuring performance. After measures are identified and performance targets are set, the next step in the control cycle is to monitor activity and evaluate performance. Measurement is the process of evaluating behaviors and outputs to see whether standards have been met or objectives have been obtained. The process of measuring can take many forms, from complex systems involving computer programs and databases to simple systems that use Excel spreadsheets. One new approach to measurement is open book management, a concept in which management shares all of the financial data of a company with all of its employees. In a transparent company, employees have access to accurate information, helping to improve their individual performance. They can also update figures with their own measurements, ensuring speedy and accurate data collection. HCL Technologies, an India-based systems integration firm, uses a vibrant intranet to share financial results and goals throughout the organization. More common are monthly and quarterly review sessions with senior managers where actual performance results are compared to forecasts, plans, and budgets. As we discussed earlier, these meetings enable the company to track its progress against expected goals. Managers are often expected to explain variances in performance and to outline recommendations for closing gaps. Other measurement systems such as Total Quality Management and Six Sigma are comprehensive processes for monitoring large-scale operations. Financial management. The long-term success or failure of a business is determined by its ability to sustain profitability, especially as the business environment changes. As such, it is very important for managers to continually assess the financial performance of the company. Two important financial statements, the balance sheet and the income statement, are very useful in helping managers monitor and measure the health of the company. The balance sheet highlights the company's financial position by identifying the assets that the firm controls and the manner in which those assets are financed. In essence, the balance sheet is a summary of the firm's assets and liabilities at a point in time, typically 1 year. Figure 10.3 shows an example of a balance sheet for the party in a box company, a company that sells prepackaged thematic party supplies. An analysis of the balance sheet can provide insight into how effectively the company utilizes its assets and manages its liabilities. A company's assets are classified as either 1, current assets, or 2, fixed assets. A company's cash, inventory, and accounts receivables, monies owed to the company from customers or other parties, are examples of current assets. The company's building and equipment are examples of fixed assets. A company's liabilities are classified as either short-term or long-term. Examples of short-term liabilities, also called current liabilities, are accounts payable, monies that the company owes to suppliers and others for items that it has agreed to purchase, income taxes payable, and other accrued expenses. Long-term liabilities include long-term debt or mortgages on property and equipment. The final major component of the balance sheet is owner's equity, which is the difference between assets and liabilities, and is comprised of retained earnings, monies earned from operations and reinvested in the business, and contributed capital, which is the value of stock of various stockholders in the company. In a balance sheet, assets must be equal to liabilities plus owner's equity. The balance sheet for party in a box for 2015 included total assets of $1,623,000, total liabilities of $765,000, and owner's equity of $858,000. To assess the ongoing health of a company, it is often useful to compare balance sheets over time. Figure 10.3 includes the balance sheet for 2014 and 2015 and indicates that the company has been able to increase its retained earnings by $64,000 in 1 year. The income statement, often called a profit and loss statement, summarizes the financial performance of the company over a specific period of time, usually monthly, quarterly, or yearly. Unlike the balance sheet, which highlights a company's financial position at one point in time, the income statement reflects cumulative business results during a specific time frame. The basic elements of an income statement can be simplified into one equation: revenues, expenses equals net income or net loss. The basic income statement has 3 primary components: 1, sales or revenue, 2, costs to produce those sales, and 3, Other expenses. Figure 10.4 includes an income statement for the party in a box company. The company has two sources of sales: 1. Retail sales and 2. Corporate sales. Cost of goods sold includes the costs associated with producing the material for the company's sales. For party in a box, these costs include the cost of the box as well as the material inside the box. Operating expenses include non-material costs such as expenses for marketing, rent, and accounting services. After deducting expenses for depreciation and taxes, the company is left with either a positive or negative income. Party in Box produced $64,000 in net income in 2015. To assess the health of a business, managers compare actual profit and loss results to both budgeted expectations and company performance in previous years. As noted in Figure 10.4, Party in a Box exceeded the budgeted sales and income figures for 2015. In fact, the company generated $22,000 more in net income than expected. In addition, the company grew sales by 15% from 2014, and net income by 95%, mostly as a result of reducing its costs of goods sold. This type of analysis helps managers determine how effective the company has been in trying to achieve specific financial and operational objectives. Key financial ratios. While the balance sheet and income statement are good starting points for measuring the financial performance of a company, there are several key financial ratios that can provide a manager with even greater insight. These ratios are also useful in comparing the performance of one company against competitors, which can support the benchmarking process. Some of the most useful ratios are liquidity ratios, profitability ratios, and leverage ratios. See Table 10.2. Liquidity ratios are used to assess a firm's ability to meet its current or short-term financial obligations. The most common liquidity ratio is the current ratio, which is current assets divided by current liabilities. The higher the ratio, the more protection the company has against liquidity problems. 63. The current ratio for Party in a Box is 2.56 for 2015, which means the company is capable of paying off its immediate debts 2.56 times. In general, this ratio seems to indicate that Party in a Box is in a relatively strong position to fulfill its short-term debt obligations. Comparing the 2014 and 2015 ratios also shows that the company has improved its performance on this metric. Profitability ratios are used to assess the firm's profits in relation to the source of those profits, including sales and assets. The profit margin ratio, calculated by dividing net income by sales, measures the operating and financial ability of management. For Party in a Box, the profit margin for 2015 was 3.8%, which is relatively low but is an improvement from 2.6% in 2014. To assess the overall financial health of the company, it is often important to understand its performance in relation to other competitors in its industry. While a 3.8% profit margin may seem low, it could be above average for a highly competitive industry, or could be appropriate for the lifecycle stage of the company. Managers need to understand what metrics are important at each stage in their business's lifecycle. For instance, companies often expect to lose money in the startup phase. Their primary objectives are based on market reach and product or service adoption. In this case, financial metrics take a backseat to consumer metrics. Consider Facebook. Since 2004, Facebook membership has skyrocketed. By 2014, over 890 million individuals accessed Facebook each day. During its first 6 years of operation, the company focused on building membership, not on financial performance. In fact, the company was not able to cover the bulk of its operating costs until 2009.64. In more mature businesses, however, the tolerance for financial loss is virtually non-existent. Process and profitability metrics take center stage. Another important profitability ratio is return on assets, ROA, which measures how well the management of the company is using the company's assets to generate income. Both the balance sheet and the income statement are needed to calculate this ratio, which is net income divided by total assets. The ROA ratio for Party in a Box in 2015 was 3.9%. $64,000 in net income divided by total assets of $1,623,000. Leverage ratios are used to evaluate a company's debt levels. Debt is typically used to finance a company's core assets, including its facilities. Debt can also be used to fund ongoing operations in a firm, including the build-up of inventory. Generally, companies that have a lot of debt are riskier investments than those with limited debt. One quick assessment of a company's leverage is the debt ratio, which is total debt divided by total assets. The debt ratio for Party in a Box for 2015 was 47%. Almost half the company's assets are being funded by short and long-term debt. Is this high or low? Again, comparing companies within similar industries helps to assess the relative strengths or weaknesses of different financial ratios. Total quality management. While financial metrics are very important in assessing a company's performance in meeting its sales, growth, and profitability goals, other metrics are useful in assessing a company's operations, manufacturing, and customer delivery processes, with the ultimate goal of fulfilling customer needs. Total quality management, TQM, has gained popularity not only in the United States, but also around the world over the past several decades. TQM is a comprehensive and structured approach to identifying ways to improve the quality of a company's products and services. Higher quality is one of the most important requirements for long-term success in many industries, because it reduces errors, thus, rework and costs are also reduced, while it satisfies customers, which translates to higher market share, better customer retention, more loyal customers, and higher prices. High quality also allows companies to easily move into new markets and acquire new customers. For example, Apple began as a producer of desktop computers, but its focus on high quality and user experience enabled the company to move into markets for laptops, music devices, cell phones, and watches. The goal of TQM is to ensure that the company produces high-quality products and services that fulfill specific customer needs. To do so, companies often review and enhance their internal operational processes with a focus on building a learning organization through continuous improvement. When looking back at the balanced scorecard, we see a similar linkage between the learning and growth, business process, and customer perspectives, making TQM a suitable complement to enforce the measures that were chosen. One of the more important measurements of TQM is total cycle time, defined as the amount of time required to develop and deliver products and services to the customer. Reducing cycle time improves quality in three fundamental ways. First, as companies use flow charts, cause-effect diagrams, and statistical tools to reduce cycle time, deficiencies in materials and processes are revealed, providing more opportunities to improve quality. Second, reducing cycle time often reduces the number of steps involved from production to delivery. As a result, the number of handoffs, parts, and delays decrease, and there are fewer chances for mistakes. Third, labor and overhead costs decrease, inventories are cut, and rework is reduced. Continuous improvement, one of the most important aspects of TQM, means a commitment to examining processes in pursuit of better methods. It relies on employees actively engaging in scientific experimentation and problem solving. During the experimentation process, employees work in teams to design and execute a series of small experiments to produce incremental gains. Using the scientific method known as plan, do, check, act to diagnose problems, employees rely on hard data rather than assumptions to make decisions for improvement. As teams work to reduce waste, improve cycle time, and increase efficiency of resources, incremental adjustments can accumulate to mimic broad, sweeping improvements. Six Sigma. Six Sigma was originally developed in the 1980s at Motorola as a method for reducing defects during the manufacturing process. More and more companies have turned to Six Sigma to quickly reduce operating costs in search of a competitive advantage. Six Sigma is a disciplined, quantitative approach to improve cycle time, reduce costs, and eliminate waste with a technical goal of 3.4 defects per million, 6 standard deviations from the mean. In practice, Six Sigma uses a method known as DMAIC, which stands for Define, Measure, Analyze, Improve, and Control. It entails defining a problem precisely, measuring to clarify the process, analyzing the process to identify root problems, improving the process by considering several solutions, and controlling through ongoing measurements to ensure the problem does not recur. Companies train employees who become black belts and are responsible for applying DMAIC to specific projects over a predetermined span of time. After identifying and measuring the key problems of a process, black belts ask why is that, over and over again, until they find the underlying problems. Since its conception, Six Sigma has abandoned its precise definition and become a more generic term, meaning the pursuit of higher quality and lower costs. While the efforts started in manufacturing, Six Sigma concepts have been transferred to other business areas such as human resources, customer service, and R&D, where the meaning of the term defects is more subjective. In recent years, 2/3 of Fortune 500 companies have used Six Sigma, but it is not the answer for all companies in all situations. Six Sigma assumes that the current product design and process are fundamentally sound and need only minor improvements. While Six Sigma can isolate and solve problems in a current framework, it fails to challenge that framework and create a new one. As such, it is most appropriate in manufacturing, where products and processes are mass customized and mass standardized. ISO 9000. Another major program that has become popular in recent years is called ISO 9000, an international control mechanism that pursues high-quality products by ensuring high-quality processes. While TQM and Six Sigma focus on improving products, ISO 9000 concentrates on the process of production. It does not provide a method to improve the end product, but requires organizations to document and measure every part of the process that contributes to the quality of an end product. To become ISO 9000 certified, a company and its suppliers must meet the ISO standards of quality. Consequently, companies that obtain certification are able to do business with other certified companies, but many critics believe it is too costly and diverts company attention from pursuing quality to pursuing quality certificates. Beyond the complexity, ISO 9000 can cost companies from thousands to millions of dollars in training, consultants, registration, and time. Improvement programs such as total quality management and cycle time reduction can overtake managers' priorities to the point that they become ends in themselves. While these programs often begin by serving customer needs and improving economic results, managers must keep an eye on tangible results, maintaining a strong linkage between these activities and financial objectives to ensure that they remain relevant. Taking corrective action. After an organization has identified measures, set targets, and monitored results, the next step is focused on corrective action and is often considered the most important part of the control cycle. As people gain experience, they learn from their achievements and mistakes. The same is true for organizations. Managers must review all aspects of their organization, assess their past successes and failures, and record the lessons in a forum that employees can access. By doing so, managers create the possibility for employees to participate in the learning process and to improve all aspects of the control cycle. With accessible information, better measurements are chosen, more informed standards are set, and improved methods of monitoring are used. In addition, through understanding the driving forces behind failures, companies turn mistakes into productive mistakes. In many cases, the lessons learned from failures can be more important than those learned from successes. When companies adopt a learning mindset, employees are focused on increasing their ability to reach preferred results, and they also learn how to learn collectively. An organization skilled at creating, acquiring, and transferring this knowledge fosters continuous improvement in processes, products, and services. Leaders generally take corrective action in two primary areas. First, they take corrective action to validate their company's strategy. The control cycle enables leaders to better assess how the company is responding to changes in the environmental landscape. Annual business reviews can be used by leaders to recommit to a certain strategy or to outline a plan for change. The second area in which leaders use measurements and corrective action is to ensure that employees are engaging in the right type of activities and producing the right results for the company. Validating the strategy. As we have discussed throughout this text, companies must continuously adapt to the business environment and revise their management control systems in light of new threats and opportunities. Because environmental changes can occur spontaneously or steadily, a business should set up a dual process to account for different possibilities. First, businesses should conduct an annual review of their strategy, comparing the organization's performance to standards and assessing the assumptions, opportunities, and threats in the market. Second, businesses should continually collect and analyze data from the environment in order to implement timely changes. The first method accounts for slow, steady changes in the market and helps managers compare business performance to standards. Managers can answer the question, "Are we meeting our strategic goals?" The second method accounts for quick, sporadic changes, and identifies new threats or opportunities. Managers can answer the question, are we pursuing the best strategy? Aligning people. As strategy is implemented and the control cycle takes place, giving feedback to employees is commonly used to correct, sustain, or improve performance. Feedback in itself improves future performance because it heightens employees' awareness of what is expected of them. As we saw in Chapter 9, if employees are maintaining or surpassing standards, managers may reward them with a pay raise, provide new opportunities, or challenge them to acquire new skills. However, if employees are performing poorly, managers tend to use punitive measures such as warnings, probation, and even termination. More effective managers take a problem-solving approach. They discuss performance with the employee, redesign the employee's job, or transfer the employee to a position that is better suited to his or her skills. Ultimately, achieving strategic objectives depends on a manager's ability to motivate employees in their work and promote cooperation between teams. For organizations to achieve certain strategic objectives, they must create a context that is performance-based and supportive. High-performance organizations are created in a manner that emphasizes performance metrics as well as support and trust. Organizations that focus solely on performance tend to lead to burnout environments. Success in these situations can be achieved in the short term, but high turnover and poor morale eventually undermine progress. At the other end of the spectrum, too much emphasis on support and development without a counterbalancing focus on performance can result in a country club context. Without a performance focus, employees tend to worry more about social interaction and less about results, eventually becoming complacent. Organizations that lack both a performance focus and supportive environment are not likely to survive very long. Summary: performance management encompasses the tools and processes that managers use to ensure a company is meeting its strategic objectives. The control cycle provides one way to measure and assess the performance of a company. The control cycle encompasses 4 key activities. 1. Identifying key measures of analysis. 2. Setting performance targets. 3. Monitoring and measuring results. And 4. Taking corrective action. The Balanced Scorecard provides a comprehensive way to identify measures of performance. The Balanced Scorecard includes a financial perspective, a customer perspective, a business process perspective, and a learning and growth perspective. Each of these perspectives, in turn, includes key metrics that help a manager better understand the performance of the firm on a number of dimensions. Certain perspectives are more important at specific points in a firm's life cycle. A company sets performance targets through both external and internal mechanisms. A key external mechanism to set performance targets is to benchmark the firm's performance against competitors or other firms that are best in class in their respective industries. Internal performance targets can be derived and monitored through budgets and forecasts. To ensure that a firm meets its targets, a manager must monitor and measure performance. A number of tools exist, which enable a manager to assess performance, including financial management, total quality management, Six Sigma, and employee evaluations. Managers need to understand that every organization is unique, whether in size, history, culture, or industry. As a result, managers must not rely on a single method of performance management. Rather, they should consider the methods as tools to use under appropriate conditions. For example, Six Sigma is most appropriate for manufacturing processes while budgeting is most appropriate for resource allocation. When a firm is not meeting its targets or objectives, a manager needs to take corrective action. Corrective action can take many forms. If the issue is employee performance, a manager may need to re-examine incentives to ensure that they are aligned with desired results. If the issue is a misaligned strategy or process, the manager may need to re-evaluate the firm's goals and objectives. As a manager examines the performance of a company, he or she may also need to recalibrate the control systems that are in place. Are they measuring what needs to be measured? Are managers getting the information that they need in a timely fashion? If not, these control systems may need to be revised. Performance management systems help a manager to assess how well a firm is pursuing its strategic, financial, and operational objectives. Chapter 10 Discussion. Chapter 10 Discussion Questions. Discussion Question 1 on the value of measuring. What does it mean when a manager says, "If you can't measure it, you can't manage it, why can't you manage it?" Discussion Question 2 on the value of benchmarking against other companies. Why would a company benchmark its performance against companies in different industries? What value can be derived from considering these completely different business contexts? Discussion question 3, on the value of maintaining transparency with employees. What tools can companies use to make their performance against key metrics transparent to all employees? What are the advantages of being transparent?